Moneycontrol and Property Share present CRE Edge.
Good evening, everyone. A multitude of investment choices awaits individuals seeking to grow their wealth. From stocks to bonds to real estate, gold, commodities to alternative assets like cryptocurrencies, the options are abundant. However, amidst this vast array, one principle stands firm: the importance of diversifying one's investment portfolio. By spreading investments across different asset classes, individuals can mitigate risk and maximize potential returns. Diversification acts as a safeguard, shielding against the volatility of any single investment. It also allows for exposure to different sectors, industries, and market conditions, ensuring a balanced approach to wealth accumulation and long term financial stability. Welcome to PropShare and Moneycontrol presents Wealth Generation through Commercial Real Estate, where we look at the current investment landscape, opportunities, and challenges. I'm Mugdha Kalra, and I'm delighted to have with me two experts on this subject. Andrew Holland, CEO, Avendus Capital Public Markets Alternate Strategies, and Kunal Muktan, co-founder and CEO, Property Share. Welcome to the show, gentlemen. And a very quick announcement before we deep dive. If you, our audiences, have any questions of your own, please send them to us and we shall take them up for sure towards the end. Andrew, let me start with you. Investment landscape has changed, and how? What has stood out for you in the last few years about these different asset classes, both old and new?
So, it's I don't think the asset classes have changed so radically. I think the number of opportunities maybe for Indian investors has increased. So, for example, over the past year or so, investors have had the ability to, directly invest, into US stocks or Nasdaq stocks, which maybe 4 or 5 years ago that wasn't available to them. So I think the number of opportunities has increased, but it's the same within the same kind of asset class, I would say. I think that the feature of the last 1 year or 2 years has been obviously the onset of private equity and venture capital in India into kind of the new sunset industry. So that's been a very, very big draw for investors. Who have made some very good money from some of the companies which have either listed or been acquired. Real estate's had a big comeback over the past few years, as well as interest rates, although they're higher now, fell quite sharply over the years. So those would be the kind of key highlights. So more opportunity to invest offshore, venture capital and private equity funds. And the unicorns that we're all searching for, and obviously real estate.
Kunal, if I could get you in, what about the commercial real estate market? I know you've studied the sector extensively in your career. What has stood out for you, particularly in the last few years, with the overall Indian growth story and the commercial real estate?
Well, commercial real estate used to be the preserve of institutional investors for a very long period of time in India. When I myself was at Blackstone for about 8 years, we were the only ones who could invest in rent yielding grade A plus commercial real estate, which in a way was a fantastic security to buy, given the fact that you could earn at that point of time 9-10% returns and get underlying appreciation on the property. So there was a growth factor as well as a current income on the asset class, but unfortunately it was very restricted. And for the longest time, like I said, it was only the Blackstone, Brookfield, GICs of the world who could really go ahead and buy these properties and these assets. But in 2014, as we know, SEBI introduced REIT regulations, thanks in a big way to the private equity funds whose portfolios had become so big that the only way to liquidate them was through an IPO and a REIT. So But the first REIT came around only in 2019, as we all know. And after that, there has been some activity. There have been two other REITs, and the fourth one just happened a few days ago. And that's, I think, one new asset class that has come in for retail investors to participate in real estate, something that has been around in the developed markets for some time, and India has been fairly new in this regard. But today you can invest in rent yielding commercial real estate primarily through the three REITs, and now the retail REIT. So and of course the InvITs. So I think that's something that's new, that's come into commercial real estate. But otherwise, commercial real estate, in its own has always been there. Investors in India love real estate, as we know, and they could always buy real estate on their own. We ourselves run a tech-enabled platform where you can directly invest in commercial real estate. This is something that came in over the last 3-4 years after tech platforms took off in India, and investors got an opportunity to invest in a separate asset class in a very different sort of a way. So there have been some innovations around the sector which have given new ways to invest in a very traditional asset class.
Kunal, this may be a little repetitive, but for the uninitiated, what are the different ways in which investors can invest in commercial real estate today? And are there any specific sectors within that they should be looking at as part of their research and also as part of their investment if they are already evolved?
Well, they could invest through REITs. That's number one that I just spoke about. They could invest through a real estate fund, a category 2 AIF, but the minimum investments there are very high. It's more for sophisticated investors. It's crore, as we know, whereas REITs are as little as one unit, which could be 300 rupees. And then there's also tech-enabled platforms, like I mentioned, like ourselves, where you could directly invest in commercial real estate, or you could directly invest yourself. You could buy a floor in your name in BKC or a Lower Parel and so on. So these are the 3-4 ways in which you can invest in commercial real estate. And to answer your second question, within the real estate industry, in India at least, commercial has been very, very successful. It's done extremely well because the Indian commercial real estate sector, very different from the West, is more outsourcing driven, and therefore when the West doesn't do very well, offshoring happens more to places like India, and obviously the cost advantage is here. So even in the 9-10 financial crisis, and even today, we've had a fair degree of interest from multinationals for taking up space in commercial space in India. So that's one sector that I would definitely focus on. Retail is picking up in some way. COVID-19 had a direct impact on that sector, of course, but after COVID has reduced over the last few years, it has definitely come back in a big way. So retail, and we saw that in the REIT, it was very well subscribed, a lot of demand from domestic as well as institutional investors. So that's also one big sector. And the biggest sector, which is the darling of the institutional investors today, has been the warehousing sector, principally because working from home, people started buying more things online, and therefore retailers needed to have more space in warehouses, which meant that third-party logistics players did extremely well, and therefore warehousing demand picked up. So today, if you ask any institutional investor, they will say warehousing is the next thing, along with some more new sectors like data centers and so on.
Right. Andrew, the basic question that always comes up: why should investors diversify across different asset classes? And is it true when people say not every investment is made for every investor? What must one consider for themselves?
So I think the basic rule is that you have to understand the risk that you want to take. Most people, I think, like to sleep well at night, so they don't want to be too risky in their portfolios. So I think that's something that you have to take into account before you start investing, is what kind of risk you want to take, and in that risk, what kind of returns are you expecting? Because that obviously has an impact on how much or how long you should be investing for. I think at the end of the day, when you look at asset classes, and I just take equities for example. I'm not going to go into investing in equities, but it's one asset class, right? Kunal will say, real estate's better. It's going to give you better returns over the next 2 years. And he might well be right. But the case is, where's the opportunity cost of investing in equities versus real estate versus gold versus any other asset class? Am I gonna, if I buy real estate as an asset, I know it's illiquid. I know it's probably going to make some money over it, but am I going to make returns quicker in equities or gold or some other asset class over the next 1 year before the cycle turns in real estate, which then I can time a little bit better? So I think it's really the opportunity cost of which asset class you pick. Obviously, each bucket has a different kind of time horizon to it. Equities can be both short term and longer term. Bond market's exactly the same. And then obviously if you're buying real estate, then you have to have a longer term horizon because illiquidity can be there for some time if markets turn down or interest rates go a lot higher from where we are today. So that's how I think investors should kind of approach it and think about what are their returns they're after, and which asset class is likely to give them that over a longer period so you can switch around, or in a shorter period if you're looking for those returns.
Right. Kunal, and you spoke about long-term horizon. How do asset classes like CRE help in long-term wealth generation?
Like Andrew mentioned, real estate has always been seen as a long-term investment. It's not something that you buy and sell in a day or a month or even a few years. Taxes have been set up that way in India, and also as an asset class, it's something that needs to mature in an investor's portfolio before he can monetize it, and therefore. CRE, while being a very important part of any person's portfolio, which if we look at any Indian's portfolio today, real estate is heavily tilted towards real estate, and it might not be an investment in a real estate fund or a REIT, but just someone buying a house as a percentage of their net worth is probably a pretty big percentage. But commercial real estate in particular has a very unique characteristic, which is it gives you, like I said, current coupon 8-9% payable quarterly, but at the same time it also allows you to make equity type returns on the underlying asset, which is what institutional investors like Blackstone have made in India. 19-20% IRRs, 8-9% on rental returns, and 9-10% on the cap rate compression, as they say, over time. So I think that's something that helps investors diversify their portfolio into slightly longer term hybrid securities. It's also inflation linked. That's something that real estate is well known for. And if we look at commercial or retail or warehousing, the underlying lease, which is the source of the securitization of the asset, increases by 5% a year or 15% every 3 years, and therefore a yield of 10% today becomes 10.5% in a year's time, 11% in a couple of years' time. And therefore, if inflation is also at around the 5% mark, then you do end up being able to buy the same basket of goods that you would have been able to buy 2 years ago, thanks to the increasing income, versus, let's say, a fixed deposit or a government security, which has a very fixed interest rate on the underlying asset.
Right. Let me get Andrew in here on investments in general. Andrew has said in investing, what is comfortable is rarely profitable. How should one go about stepping out of their comfort zones then and diversifying their portfolios, given that there is so much and everybody wants to try everything that is working for others, but sometimes perhaps they don't research it well. But having said that, getting out of the comfort zone, I think, is what a lot of investors need to do.
So again, it depends on where you're starting. If you're starting at the very start of your investment journey, then it's always good to be cautious. So let's work on the basis that most people who are looking to invest have already bought their first property as where they live and will live for a long time, because that's usually the largest part, as Kunal mentioned, of the asset class that they own at that top point. Then it depends on their age, and the kind of rule of thumb that I've used is that you take 100 minus your age, and that's the portion you should have in equity. Because if you're a young person, you don't want it all in high yielding debt, because that's not going to give you the returns for the long term. So you'd want to be in equity. So let's say you're 20 years old, you'd be 80% equity and 20% debt, if that's the kind of portfolio you wanted to start with. And then obviously as time goes on and you continue investing, then you should put 10% away for what we kind of call alternative investments. And that could be REITs, it could be gold, it could be hedge funds, it could be wine or whiskey, or it could be many different alternative investments which you could get a higher return, but for a smaller amount of your money parked into those assets. So those would be, I would say, a little bit more risky unless you do your homework. So you've got to do your homework as well on those assets, right? It's like if you buy if you buy art, I mean, you can either hang it up at your house because you love the painting, or it's really an investment where you expect to make money. So you'd have to at least have the knowledge, or have someone who can help you with that knowledge to advise you. So I think you build up your portfolio. Housing is usually the first part, and then equity, and then alternative investments.
Well, to sum it then, this question, would there be an ideal allocation for each asset class? Or do you say that it varies largely for people to people? But is there a ratio then?
I said, they're usually so it depends obviously on your own preference or knowledge. So I think most people, 10 to 15% can be in alternative assets, which can range from, as I said, art to wine to gold, those kind of asset classes. But the bulk of it should be in, your real estate and your equities and bonds. That's where you're going to get your compound growth over time. The other parts will give you some, good returns, but it's all about timing, right? It's all about those asset classes moving at the right time. I mean, gold hadn't moved for a very long time; it's only been recently. So it's that time. People say, "Oh, I've had gold and I've made money in gold," but in the last 2 years, they probably didn't make any money. Whereas people in maybe real estate made a lot of money. So it really goes back to the opportunity cost of which asset class you're in.
Kunal, where does CRE fit in the investor's portfolio? What is then an ideal allocation to CRE in an investor's portfolio, and the kind of investor goal risk profile CRE is best suited for?
That's the answer we're all looking for. What's the ideal allocation? And lots of academic research has been spent on this. But like Andrew said, there are certain asset classes which have performed consistently over time. Equities, real estate, for example. I do believe that it all depends on, like he said, how old you are, where you are in your investment cycle, what exactly you're looking for from your investment. Are you looking for current income to help you? Maybe you're in your 50s and you're preparing now for retirement, and you'd like to see constant cash flow coming in to help you over the next 15, 20 years, or you're in your early 30s, and therefore you can take more risk and allocate more towards equities or risky real estate, because real estate also has various types of risks associated with it. You could be in early stage land. Lots of funds did that. They burnt their fingers in 2007 and 8. You could do brownfield, or you could do, for the purposes of our discussion today, what we call commercial real estate, which is rent yielding real estate, which is fairly stable, will never give you 20-25% returns, but you can definitely expect to make between maybe 12 to 15% unleveraged returns. So I would say that in terms of percentage, depending on where you are, you could go up to a third or 25% of your portfolio, depending on what you're looking for from real estate.
Let's talk about the regulatory framework, and let's talk about tax planning, etc. And we're coming to the fundamentals of portfolio building. Why is tax planning a critical factor then while deciding on your assets as well?
Well, I think basically you don't want to give too much in the way in tax, right? I think we all want to kind of avoid that. So there are different products which can help you do that as well. But I think that's I would say that's probably, I'm not saying out of the realms for the retail investor, but I think you have to be a lot more sophisticated in terms of looking after the tax. But the government here is really trying to get a level playing field across the tax regime, and you've seen that more recently in that if you can't if you invest now in fixed income products, you're going to be charged 42%. So they're taking all the loopholes away from that and made it a level playing field for particularly in the fixed income market. There's question marks over now whether the capital gains for equities should be, everyone should be charged the same, basically, is probably where the government's trying to kind of move us, maybe not so close to the elections, but who knows. So that's where we're going. So I think the tax loopholes become, or the tax kind of kind of planning. I don't think, depends again how old you are. And I think if you're young and you've got your earnings capacity ahead of you, then it's really about your capital gains rather than your kind of income. So therefore, we know what the capital gains tax are in equities, for example, and it's pretty similar across other asset classes as well. And they are closing down some of those kind of reinvestment of property from sale of properties, and where you used to be able to get a lower tax or lower capital gains tax if you invested straight away. So I think the tax planning is very important, particularly if you're thinking about I think about wills and things like that. And again, there's no inheritance tax, maybe in the future that might be something that could be looked at by the government going forward.
Kunal, what are the tax benefits in CRE investments?
There are a few, although they are closing many of them, like Andrew mentioned, and the government has always been favorable to the real estate sector in terms of tax. For example, you could, on your rental income, you don't pay 30% or your marginal tax rate. You get a standard deduction, which is still available today, and you end up paying only a 20% tax on rents, which is still quite a big difference from, let's say, fixed income instruments where, like Andrew mentioned, you pay the entire 42%. And in capital gains, there is still a very strong incentive to invest in real estate, because if you hold it for a longer period of time, let's say 2 years in terms of securities, or 3 years in terms of the actual real estate, then you only need to pay 20% capital gains tax, and that too after an indexation benefit, which over the years have been close to 6-7% thanks to inflation every year. So if you buy something for, let's say, $100 today in India, and you sell it for $150, which is a 50% increase, you'll only end up paying maybe $5 of tax, because the government allows you to index up the cost price to 120 in 3 years, and then on top of that, on the remaining 30, you only end up paying 20%, which is 6 rupees on a 50 rupee gain. So that, I think, is still a significant tax gain that is still available in real estate, and commercial real estate in particular, apart from the fact that rent is also taxed at a lower marginal tax rate versus government securities. But if we look at REITs, for example, REITs, the dividends are not taxed at all in the hands of the investor. And until February of this year, neither were other parts of the returns, principally the part where they used to return the principal portion of the debt, which there was a certain amount of creative accounting that a lot of REITs have done. And the government has now closed that loophole, saying, look, now you need to pay tax on REITs the same as equities or any other instruments.
Well, before I move ahead, let me just quickly remind our audience that if you have any questions for Andrew or otherwise also, if I have missed taking any questions with Kunal and Andrew, please go ahead and type them down, and we will get them to elaborate on it if you think that you need more information on that. So that was just a quick reminder. All right. I wanted to come back to you, Andrew, on the importance of having a good financial advisor. Usually, what happens is that when people are investing, it's a hearsay. My friend is doing this, so I'm going to do this. My banker says, asks me to do this, or this is the trend, which is what we saw with cryptocurrencies recently. Then there was FOMO; everybody wanted to get on that crypto wagon. Uh, how important is it to have a financial consultant and an advisor of sorts?
No, I think it's I think it's very important. I think for a number of reasons is that I think we all get carried away, right? In terms of you let's just take the stock market for example, because obviously things happen a little bit quicker there. You buy some stocks, or someone recommends some stocks, and they go up, and then you get more and more kind of excited that that's going to continue to happen. And you're not looking at any kind of risks. You're not looking at what could go wrong. You're not looking at global factors or local economic factors. Whereas I think a financial advisor will sit there and say, listen, we have enough equity exposure. We should have a little bit more, be more cautious. Markets have risen very quickly. Therefore, we shouldn't really be kind of investing too much more now. Why don't we look at other asset classes where there could be a better return over the next 6 to 12 months if you're looking shorter term, and obviously longer term you can put those forward. So I think having a financial advisor should be able to kind of give you that comfort that what you're doing is correct, and what you're thinking is correct, but also I think hold you back when you're getting too excited in one asset class, and just kind of putting a little bit of a dampener on your enthusiasm to get you to the right asset allocation, rather than saying, I'm going to put all my money in crypto tomorrow, because I think that would be a hugely risky thing to do. And so I think they sober you up, is what I would say, as well as giving good advice after they've worked out your kind of risk profile and what kind of returns that you're looking to achieve and over what period. They'll obviously help you as you're planning about if you've got children or you're expecting children in the future, about that education and the financing of that, or universities, or just holidays. All of those things I think they can help you with.
Kunal, would you want to chime in on that? Because in the real estate sector and commercial real estate, and you're talking about warehouses, and you're talking about data centers, you're talking about the expansion of the commercial real estate market around COVID, after COVID, and there are these projects which are coming up in several geographies that we aren't even aware of. How important does an advisory service become for a high net worth individual, and also for somebody who wants to explore a market that is away from them and yet is lucrative? And how should they go about it?
I would say you definitely need a financial advisor in something like real estate. It's not a very simple asset class. It's not liquid. It's meant to be held longer term, and there are various nuances that that particular asset class has which others don't, and you need to really be able to understand them before you commit a significant amount or even a small portion of your investment capital. So for example, just if I speak about commercial real estate, you should be able to understand lease structures, who's done the interior fit outs, that plays a big difference, the location, who the tenant is, what kind of escalations he's paying, where the building is located, what are the vacancies in that particular micro market, what's the supply that's coming in, the demand. a normal retail investor will not be able to devote the time, effort, or even have the resources available to him to go and see some of these things. And that's why you have asset managers who specifically look at this particular asset class, and where pension funds or family offices or high net worth investors or even retail investors allocate their capital to, because they are specifically doing this particular type of investing for a very long period of time. And within real estate, every kind of asset class has a very different flavor to it and different drivers. For example, the warehousing asset class is driven to a large extent, like I said, by logistics, by online buying patterns. Commercial real estate in India is driven largely by the performance of the technology sector, because they are the majority tenants in commercial real estate. And in retail, it's consumption patterns, and so on and so forth. And data centers, it's a completely new asset class. We are still understanding what the key drivers are. So to take up the mantle upon yourself to go ahead and do the research and try to invest in asset class like this is obviously a pretty tall ask. Most people don't have the time to go and do research on a very simple fixed deposit. So forget about something as complicated as real estate. So to answer your question, I definitely think that you need someone who's an expert in the field, who has the experience, who's done this for many years, to be able to allocate capital to that asset class.
I think in that scenario, it also then becomes very important to have someone advise you about when to exit when a plan is not working. And Andrew, how important then an exit plan also becomes when you have committed yourself to an asset class, but usually what happens is people do not sit and review it very often. And I guess that's the reason why it is very important perhaps to also have an exit plan in head if your return on investment is going down dismal, or perhaps can be utilized in a better fashion.
Yeah, and again, that goes back to the the point I was making about the opportunity cost. So I think along with your advisor, you should be looking, I would say, monthly is too short term, I would say, because if you invest in something, you want to hold it over that period. If you're saying 5 years, but in the first year it's going down, you shouldn't also be panicked into selling it, right? Because over the next 4 years, you'll probably get those returns that you were looking for. So I think, again, it goes back to, your time horizon, reviewing your investments, but it's really asset allocation you should be reviewing, not necessarily whether, because that's gone down, you should be switching into this. If you're happy with that asset allocation, then keep there, and keep looking at the opportunity cost. But I think if you kind of, the mistake that we all make, and I make it many times, right? In that, I buy something, it doesn't quite go where I'm thinking it's going. I think, oh, I should sell it in because this is doing better. And then I do it, and then I regret completely that I've done that, because actually what I was thinking was correct. So I think not to look too short term, but it's, again, just moving it around, right? You've got 100 rupees. You might be, say, 50 real estate, 50 equity, let's say 40 equity and 10% alternative assets. That you might switch it around over time. You might say, okay, the real estate market has done well. I've got some properties. I'll get the capital out, and I might be more equity in the future. Or I might be more alternative assets. So that's the way I would kind of look to invest, without trying to put too much emotion in it.
Kunal, what are some of the classic mistakes that people make when they look at commercial real estate markets or real estate markets in general? What should they be wary?
It's very similar to what Andrew just pointed out. A lot of people act out of emotion. Obviously, they see, for example, if I give the example of the COVID-19 pandemic, I was just speaking to, the CEO of one of the REITs earlier today, and he was mentioning that after the lockdown, out of the 180 odd tenants that he had, he received 90 notices in one day. And when something like that happens, I mean, you're want to say, look, I mean, this is something that is a once in a lifetime phenomenon, and therefore this is not going to be something that is going to be very good for the commercial real estate market. So nobody's going to come to office anymore. So let's just sell everything and get out of this now. But the fact of the matter is that, if the underlying real estate and the economics and also the fundamental human behavior is not likely to change, then you are probably not making the right decision to sell everything at a big loss. And that's exactly what happened. None of the big parks had any large vacancies. None of the big multinationals really left any of the large parks. 99% of the rents were collected by all of the REITs through the pandemic. So, I mean, a lot of the classic mistake, to answer your question, is always to act on a particular type of information that's come in, a herd mentality where everybody says this is something that's very bad, so let's sell and put it in something that everybody's putting in. And that's exactly where you end up misallocating capital and buying something extremely expensive and selling something which you shouldn't have at a very cheap price. So that's something that happens in real estate quite often. And that's a mistake that most investors should try to avoid as much as possible.
Taking the discussion forward, Andrew, if I could come to you on exploring geographies and getting out of, say, India and looking at geographies outside of the country, and what are some of the thoughts that come to your mind or advice that comes to your mind when we talk about exploring new geographies?
So I think typically what's happened in the past is that obviously most people had their first kind of I would say kind of diversification of asset allocation overseas has been property. I mean, your LRS is $250,000. I know it's kind of wavered over the years, but that's what it is at the moment. So a family of four could put a £1 million or $1 million. And typically they've used that to buy real estate, whether it's the US or the UK, those places in particular. So that's been the first wave of I believe, your kind of asset class diversification away from kind of India. Also gives you that diversification that you're in a different currency then, right? If you're owning property in the UK, you're in pounds, or US, you're in dollars. So it kind of increases your diversification from rupee risk going forward. Increasingly now with your LRS being able to use it to invest in offshore equities. So you could buy in tech companies in the US like Tesla or Microsoft. I think a lot of investors have started along that route as well. Now here's the problem with that, is that again it goes back to the advice. What's the best way to take opportunities to invest in overseas markets. So we don't know them, right? We don't know the companies there that well. We haven't got the ability to go and analyze them. So a lot of investors will probably go through ETFs. If you want to buy a tech ETF, then that's one way of just being a participant in it. But I think where the problem lies for Indian investors in looking offshore is that it's going to be very difficult for them to get a viewpoint of how that economy is doing, which sectors are doing well. So unless you're really covering that market, it's best to do it through a mutual fund or someone linked to a mutual fund in the early stages, because it's tough to. I know a lot of people told me a few years back, you've got to buy NASDAQ and there's funds there. Fortunately, I didn't, otherwise I would have been lost a lot of money. But that's what happens, and that became a bit of a frenzy at the time, right? Which is what Kunal has mentioned, is that we all get carried away, and and we always hear The great thing about in investments, and it doesn't matter which asset class, is that you always find someone who's kind of bought at the bottom, sold at the top, and they're making a lot more money than you, so they must be right. And then you find what they don't tell you is where they've lost money. People don't tell you that, oh, I lost a lot of money in this. They only tell you the winners. They never tell you the losers. So that's the lessons I've learned. And one of the other lesson I've learned is that if someone gives me in particular, say, a stock tip, I'm probably the last person to be told, right? So I'm the last one. I think I'm the last one to fall for this. So after I buy, then obviously the share price will fall.
Got it. If I could put the same question to you, Kunal, CRE opportunities in international market, what should one be wary of? What should one be looking at? And what are some of those markets that can be explored at the moment? Although there is a huge amount of interest in the real estate sector in India as well.
Yes, and like Andrew mentioned, the LRS opens up international real estate. That's the one avenue that Indians have used to invest in real estate primarily until recently, when global stocks opened up and investors started putting their money into FTSE 100 or Dow Jones, or some of the big American tech and multinational companies. But primarily LRS was used as a way to invest in real estate and residential real estate in that sense. But over the last few years, quite a few options have opened up. Real estate, thankfully, behaves very similarly across the world, and the same parameters that work for it in India work outside: interest rate, inflation. They are all yield-driven investments, so they behave in a very similar way. But if I were to look today at how the international real estate markets have been doing, then clearly commercial real estate has suffered in a big way in the US, in Europe, because compared to India, these are all front office driven markets, which have been affected in a big way by work from home. And therefore, we have seen the likes of even Brookfield, Blackstone, some of the largest private equity funds owning a lot of real estate in the commercial sector, which are either vacant or where rents have not moved. And because of the fact that these investment managers also take a lot of debt to make returns, because unlike India, which grows at 6-7% a year, some of these markets, the only way for you to make money is by levering up the investment 90-95% and hoping for a 10% gain on the underlying real estate, so that you can double your money from $10 that you put in with $90 of debt. Even if it goes to 110, you've effectively made a lot of money. That's how big real estate funds have made money in the past. And they're suffering right now. So commercial real estate has suffered. That's not somewhere I would go. But warehousing, like I mentioned, is something that has done really well post-COVID, and it has a pretty solid story going for it. A lot of the investments have moved online. In the UK, for example, almost from 20%, it has moved to 35-40% of total buying is now online. People are very used to going online and buying even clothes, and other stuff that they were not comfortable buying before. So that's really driven the need for quality warehousing. And compared to India, supply is very limited in these markets, so it's very difficult to build a warehouse. You need to have proper planning permissions. Labor is not cheap, so it's very difficult to build new warehouses. And therefore, if you can get your hands on existing high quality warehousing assets with a very long lease tenure, then that's definitely the asset class I would go for. In prop share, for example, 15-20% of our AUM is actually in UK warehousing assets. We own quite a few warehouses in the UK, and we've allowed investors to participate in that warehousing opportunity. It's especially lucrative for non-resident investors who are not bound by the LRS ODI provisions or the 20% TCS that has now been introduced. For a non-resident investor, his investment is quite fungible. He can just transfer from Dubai or Hong Kong, Singapore, the US into the asset, either through an SPV or directly into the UK asset. And when dividends are paid out, if you are someone sitting in the Middle East, then it's tax-free for you. So you earn tax-free 8.5, 9% yields today. buying high quality warehousing real estate in some of these countries.
Got it. And now we have some questions pouring in. Ravi is asking, it's a question on CRE, so I'll put it to you, Kunal. How does the macroeconomic environment impact the performance of CRE investments? And what factors should investors consider when evaluating potential opportunities? You've already answered it in bits and pieces throughout this hour, but yes, a very specific question. So, all yours.
Yes, macroeconomic environment obviously impacts the performance of CRE in a very big way because CRE is a rent yielding product, a yield asset. Ultimately, the underlying asset is a rent generating piece of real estate, and therefore, as soon as interest rates go up, just like in any other coupon bearing instrument, the value of the underlying asset goes down. So if you bought something at a 10% yield at a 5% interest rate, if the interest rate goes to 7-8%, then that particular risk premium between the 5 and 10%, which is 500 basis points, still continues to remain the same. So it goes to 12%. So what if you hold something, a paper worth 10%, that's going to become 20-25% cheaper going forward. So macroeconomics, especially interest rate, which is driven in part by inflation, makes a big impact on the performance of commercial real estate. And in the past, we've seen that if you invest in such asset classes in a high inflation, high interest rate environment, then the chances of making returns are also quite high because you end up going in at a very low base. Just to give an example of the UK warehousing market, what was trading at 3.5% a year ago in some of the prime UK markets started trading at 6.5%, which is actually 100% reduction in price. And because there was a run on some of the funds, they had liquidation pressures. We actually bought it from two assets from very large funds, $500 billion plus assets under management, who had redemption pressures from their investors. Who just wanted to liquidate, obviously, the crown jewels, because that's the only one that can be liquidated at that point of time. So if you buy assets, especially in real estate, in these scenarios, then you will mostly end up making pretty decent returns. So you should definitely consider these 2-3 parameters while evaluating potential opportunities.
Another question that is often asked, and Varun here seems to be asking the same question, and I want to put that to both of you, which is, in the light of recent market volatility, what risk management strategies should investors employ when investing in CRE? That's for you, Kunal. And in general, when it comes to investment, what should they be doing? Andrew, for you, are we getting into a recession is another question that comes often, and how should I look at my portfolio then? So these are two broad-based questions that are coming to us. Andrew, would you like to go ahead first?
Sure. So again, it goes back to what you believe to be the outlook from a macro viewpoint. So let's just take a view. This is where we are today. We think interest rates will come down over the next 1 year from where we are today. Would that mean I should buy equities? Probably more likely. Would that mean I would probably want to move away from high yielding assets? Probably yes, because they won't do as well in interest rate. The equity portion might do well within that, but the yield obviously won't make up for the kind of capital gains you make in other assets. So you have to look at it from that perspective. But the volatility part of it, I mean, I think again it goes back to whether if you're a longer term investor, you just don't put your mind to it, because you're going to only make mistakes by doing that. But if you're a short term, if you're trading the markets more as a retail investor, then just have very strong stop loss limits, which means that you don't suffer too much pain. And when in our fund we would employ something like, if the stock was to fall from your original cost price by 10%, it sends alarms to you, right? You bought it for a reason. What's the reason? Is there anything going wrong? And then at say 15%, you just take it out of the portfolio altogether because there's something you're missing. There's something that might not be right. You can always buy it back again, and 2 or 3 months time, if something was just the markets, for that example, was bringing the share price down. But have strong stop loss limits would be my view, and not too much. I'm talking about equity markets, not too much sector concentration. So don't have all your eggs in, say, the banking sector. You should be diversified around it there as well. Would be my response to your question.
Kunal, you want to take a shot at that? I'm sure you get asked that question a lot.
Yeah, quite a bit, especially in the recent few weeks and months, where there's been a fair degree of volatility in all markets globally as well as in India. But I always say the same things, which is at the very point of buying, you can do so many things to ensure that you don't get as affected by market volatility or the external economic environment than you would normally. For example, I would buy at obviously slightly higher yields going in, which means lower prices, because that's what will be available. You can pick and choose the best assets in a bad market, and in real estate, that's when you really make returns. When we were at Blackstone in 7, 8, 9, we didn't invest anything, but in 10, 11, 12, when everybody left the market, we invested all of our equity during that time, and those returned fantastic returns for our investors, because we bought them really cheap and at prices that were not really available. So one thing, while going in itself, you should try to get in at a really a good price. That's important in real estate. At the same time, what you can definitely do is not use too much leverage, because leverage is what really makes an investor's life painful. You have 80% leverage in a commercial office building, the tenant vacates, now you're left with a loan to be serviced. At the same time, you need to make EMI payments and so on, and then that can drive you to make really bad decisions. Get a lower quality tenant, or just sell it at a really low price. So try to take as little leverage as possible in a bad market. Restrict it to a maximum of maybe 50% if you can, but go lower if you don't need as much, especially if interest rates are high. And what you can obviously also do is you need to be really careful on who you are tenanting the office building to. If it's a Morgan Stanley or a Microsoft or a Google, then you're good. They are not going to make pretty hasty decisions and then leave you without cash flow. Try to get more tenants, not just have a single tenanted building where all your risks are in with one particular tenant in one particular industry, but have 3 or 4 tenants, so that even if one vacates, the chances of all 4 vacating at the same time is much lower than one person vacating that office building. So you should try to diversify your tenant base. Try to take tenants who have a longer lock-in period. That's something that's very unique to India. We have a lock-in period where the tenant just can't vacate for usually 3 years. In the UK, for example, there is no concept of lock-in. It's just tenants are locked in for the entire tenure of the lease unless they go bankrupt. So in all of the warehouses that we've bought solid tenants, 10 years plus lease left. So until they were to go really bankrupt, you are fairly well protected. So you can do these 3-4 very basic things to make sure that you put in risk management strategies while buying commercial real estate.
Varun, I hope that answered your question, and thank you, gentlemen. I'm afraid we have time only for this much. Thank you so much for taking out time for us and sharing these wonderful insights. Thank you so much.
Moneycontrol and Property Share present CRE Edge.